Okay, good afternoon and welcome back to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we have a very special topic on how to enhance your equity position using options. Now, traditionally, I usually sit here and I do these webinars and I talk to you guys about option strategies. And that's predominantly what we're going to cover here today. However, the strategies that we're going to cover here today are for those of you that are equity investors, meaning they are only suitable for the equity investments that you have in your portfolio. So today, what I really want to do, number one, primarily, is I want to illuminate the power of options and how they can be used to enhance your equity positions. So this is for those of you that invest in stocks or ETFs. And we want to show you how the income that you receive from these strategies can help you create better risk-adjusted returns on your stock and ETF holdings. Now, in order to really capture the benefits of the things that we're going to show you here today, it does require you to systematically have a strategy to sell options to generate this type of benefit. So the secondary part that I want to show you here today is how to automate your workflow using the strategies that we're going to teach you here today. So I want to show you how to remove the option chains from your workflow and use a tool like Options Play to make the process for selecting expiration dates and strike prices as easy as possible to help you automate your workflow so that you have a higher chance of actually executing the types of strategies that we're going to show you here today. Now, just by a quick show of hands here, if you can click on the chat window at the bottom of your screen, and just type a yes if you currently own or have stocks or ETFs in your portfolio, and type no if you do not invest in any types of stocks or ETFs, just so I can get a sense for the audience here in the room. Okay, looks like a resounding number of yeses, a couple of nos. Okay, so for those of you that do not invest in any equities, meaning you don't buy any stocks, you don't buy any ETFs, this might not be the right webinar for you, because today we're going to talk about option strategies that are solely focused for those of you that are equity investors and how you can utilize these strategies to help you create better risk-adjusted returns on those equity investments. So today I'm going to go over two very basic option strategies that will replace two things that you currently are already doing as an equity investor. So as an equity investor, you are likely placing limit orders to buy your stocks, and you're likely placing limit orders to sell your stocks eventually when they reach their target price. So what we're going to show you today is how two option strategies replace placing a limit order to buy your stock and an option strategy that's designed to help you replace placing a limit order to sell your stock. Now, arguably, these are two of the most important option strategies to understand, because all other option strategies really are a graduation from this type of strategy into more advanced strategies. So today, we're really going to talk about how to create an income stream by selling a cash secured put and a cover call, and utilize that income stream to help you create a better risk-adjusted return. And I think today what's going to be a little different than what I usually do is really how I present the strategies, because normally we think about cover calls as an income generating strategy, and cash secured puts as a stock acquisition strategy. So today what we want to do is want to show you a different way to looking at that type of strategy so that you can see how it really just replicates what you're currently doing with better risk-adjusted returns. So let's go ahead and get started. Just a quick disclaimer, what I'm going to talk about here today is for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to Options Play, you can sign up for a link here at the bottom, because today I will send I will show everyone a platform. If you do not already have access to this free platform, you can sign up through the link I just sent to everyone in the chat window. This gives you free access to the platform I'm gonna show you guys here today. It'll give you access to buy weekly options educational webinars like the one that you're on here today, as well as a free options video library and weekly cover call and short put reports that are directly related to the two strategies that we're going to discuss here today. So very important for you to sign up if you don't already have access. And again, it's free of charge to everyone as a courtesy of the Montreal Exchange. So I highly recommend everyone to take advantage of this offer. So a few things that we're going to go over here today. First, we're going to talk about what are the top 2 income strategies and why they relate to your equity investments and why your equity investments provide an opportunity for these 2 option strategies to help you create a better risk-adjusted return. Once we understand the strategies and what they are, then we're going to discuss what are the optimal settings for these types of strategies, what type of expiration dates, what types of strike prices, and then lastly, show you the types of reports that we have generated to help you automate this process. Everything that we're going to create here today is really designed to not just show you the strategy, but more importantly, make sure that you have the tools to implement it. So the reports are designed to help you implement. The automated income strategies within Options Play is designed to help you implement. And then lastly, what we'll do is we'll wrap this up by talking a little bit about the exit strategies, how to manage these trades once you're in them. So those are the different things we're going to go over here today. A lot to cover, so let's go ahead and get started. Normally when we talk about income generating strategies, pretty much anywhere that you look, you're first going to learn about cover calls. I'm going to skip cover calls for now because cover calls assumes that you already own the stock. Now, we know that every single equity investment starts with purchasing that stock. So that's why I'm going to start my presentation on short puts, because short puts is really a way to help you acquire your shares at a discount. So when you sell a put, what happens, right? This is a strategy that I find a lot of beginners, especially when you first learn about a short put, will say that's not for me. There's a lot of risk in that. But you have to really think about what is short put comparing it to. So when you're selling a put, what you're doing is you're attempting to acquire some stock, just like when you place a limit order. So when you sell a put at the purchase price to acquire the stock, that allows you to do the same thing as placing a limit order, because when you sell a put, you have an obligation to buy that stock. Just like when you place a limit order to buy a stock, you're obligated to buy that stock. Now, when you place a limit order, you have to set a price. Same thing when you sell a put. You can sell a put at the purchase price that you want to purchase. Whoops. You want to set a purchase price by selling a short put at the strike price. And at expiration, you would be obligated to purchase those shares if the stock is below the strike price. And each put that you sell will deliver to you 100 shares of that underlying stock. And to do this, it requires you to put up some cash or margin to sell those puts, which is equivalent to the buying power that's removed in your account in order to place a limit order. And this strategy allows you to acquire shares at a discount, usually anywhere from 50 to 100 basis points per expiration cycle. So imagine getting a 0.5 to 1% discount on every single stock purchase that you buy. You know, what would that do for your bottom line just on that alone? So those are some of the things that I really want you to start thinking about, is how can you get a discount on every single stock that you purchase? And one way to do that is by selling a cash secured put. And once you sell this put, you effectively have 2 possibilities. The stock will either be above the strike price at expiration. If that's the case, you can rinse and repeat the strategy for additional income as long as you continue to want to purchase that stock. Or if the stock is below the strike price at expiration, now you own the stock at the strike price minus the premium that you received on the selling the put. So that is the discount factor that you're going to receive when the stock does go below the strike price. Now, instead of continuing to talk about the strategy, I'm gonna move on to the next one. I'm gonna come back to this in a real example to make this a little bit more concrete. So let's say you sell that cash secured put and you end up actually owning those shares. Once you own those shares, now it's time to start thinking about cover calls, because cover calls allow you to generate income on the assets that you own, and the assets being the stocks that you hold in your portfolio. So what you want to do when you're selling a cover call is you want to sell a call at the target price that you have on the existing stock position. So when you're selling a put, you want to sell the put at the price that you want to purchase the stock at. But when you're selling a cover call, you want to sell a cover call at the target price that you have on the stock. And again, we'll go through some examples to make this a little bit more concrete. But once you sell a cover call, you have an obligation to sell the stock at the strike price upon expiration. So you just like when you place a limit order, when the stock rises to that price, you have to sell your stock. Same thing with a cover call, where you're effectively obligating yourself to selling your stock at a higher price sometime in the future. Now, this does require at least 100 shares. So if you're purchasing all of your stock by cash secured puts, this will be just okay for you. But if, let's say, you've purchased some stocks on your own, just with a limit order or some other or market order, and you have less than 100 shares, this is not a strategy that you can trade. Now, the reason that you want to sell a cover call is really to allow you to take profit as the stock rallies significantly. Now, I have an asterisk up here after that statement, because that statement is only true if you follow the methodology that we're going to show you here today. So when you sell a cover call, you have two possible outcomes. The stock can go above the strike price at expiration. What happens is you sell your stock at a profit at the strike price that you receive, and you have some income to show for that. However, if the stock is below the strike price, that's when you can, again, rinse and repeat the strategy for additional income. That's how you start building an income stream on the stocks that you own or the assets that you own. These are your assets that are sitting in your account. You can generate yield off of that by selling cover calls. This is really why you should consider utilizing this strategy for all the stocks that you currently own in your portfolio. So with that, just a quick recap before we move on to a real explanation or a real example of this. What you want to do when you're buying any type of equities and to maximize the risk and reward of your equities is to really buy low and sell high. Now, that's a concept that I think everyone understands. Buy low, sell high. So how do you actually buy low and how do you actually sell high? And that's where cash secured puts and cover calls allow you to do that or force you to do that. Because when you sell a cash secured put, it's purchasing stocks at a lower price plus an additional discount. This allows you to dollar cost average and generate a discount on all stock purchases. And again, this compares to placing a limit order to buy at a lower price. Again, we're going to go through an example to make this a little bit more concrete. And this is a strategy for any stocks that you wish to purchase. Once you're in those stocks, you want to try to take profit on those stocks after they rally. So one of the ways you can do this is by selling a cover call, which is comparable to placing a limit order to sell your stock at a higher price. And lastly, this is a strategy for any stock or ETF that you currently hold in your portfolio. So the goal here, again, is to make sure that we buy at a lower price and then we sell at a higher price. And that's what a cash secured put and a cover call forces you to do, and applies a bit of discipline to your trading to force you to buy low and sell high. Now, let's go through a real example, and I think this is going to help make this a little bit more concrete for those of you that are unfamiliar with the strategy. But let's say I have a stock that's currently trading at $100. Stock XYZ currently trading at $100 a share. Now, let's say in this particular case, I'm bullish on the stock and I think it's going to go higher. So what can I do? Number one, as an equity investor, I can place a limit order to buy the stock at a lower price. So let's say I wish to purchase 100 shares of stock XYZ at $95, and I have a target price of $120 on this particular stock. So as an equity investor, I can place a limit order to buy the stock at $95. As an options seller, I can sell a $95 put and collect some income for it. So I'm obligated to do the same thing in both scenarios, but when I sell a put, I get paid $2 in income to do that. So think about when you place a limit order. There's a buying power that comes out of your account when you place that limit order. So cash is leaving in your account and you're not generating yield on that cash. So why should you let that cash just sit there while it waits for the limit order to fill? And this is one way to generate some yield on that cash that comes out of your account when you place that limit order. So as you can see here, what we're going to want to do is we want to compare a few different things. Number one, total risk. When you buy in a stock with your limit order, your risk is the amount that you've paid for the stock, $95 a share. if you were to sell the cash secured put, because you received $2 in income, your risk is reduced from $95 a share to $93 a share. So right off the bat, you're reducing your risk just a small amount, but you are still reducing your overall risk. Your potential reward gets larger, because with a limit order, if you buy at 95, you sell it at 120, your max reward is $25. When you sell a cash secured put, because you've received that $2 income, now your maximum reward goes from 25 to 27. So not only have I reduced my potential risk, I've also increased my potential reward. This is the risk-adjusted returns that you're going to be able to enhance on an equity strategy just by selling a cash secured put. Now your strategy is profitable as long as the stock is above 93, not just above 95. And lastly, you maintain exposure. You maintain no exposure in stock XYZ until the stock declines to 95 when you place that limit order. Conversely, when you sell a cash secured put, you can rinse and repeat the strategy until it declines to 95. So you can continuously generate yield on your cash that you're putting aside to purchase this stock, as long as you're waiting for that stock purchase to execute. And this strategy allows you to purchase these shares at least $2 a share cheaper because of the $2 that you required by selling that cash secured put. So that's really how the mechanics of a cash secured put works. It's fairly simple. You're basically selling a put at the same price that you would place a limit order, but you're going to get paid to place that cash secured put, and that income that you receive will go to provide you a discount on the stock purchase, which lowers your risk and increases your potential reward on the overall trade. So now that you've acquired these shares, what do you do next? Now that I've purchased 100 of these shares, now I want to sell these shares later at a higher price. So I think the stock's going to rise. I think it's going to go to 120. So what do I do? As an equity investor, I would simply place a limit order to sell the stock at 120, and I would wait. That could take 1 day, 1 month, 1 year, 10 years. I have no idea how long it'll take. But when I place that limit order, I'm basically waiting for the stock to rally to that point, and then it will execute. On the flip side, as an options trader, what I can do is I can effectively obligate myself to the same thing, but generate some income. So I can sell a 120 covered call, so at the strike price that I want to sell my stock at, but I'm going to now collect some income to do that. So let's say I collect $2 on this income. So what this does is it further enhances your risk to reward strategy, because as an equity investor, my risk stays $95 a share because that's what I purchased it for. As a cover call and cash secured trader, what I've done is I've reduced my risk even further. So I've reduced my risk from 95 to 93 by selling the cash secured put, but by selling the cover call, I'm getting another $2. So now I've reduced my overall risk from 95 to 91. My potential reward as an equity investor remains the same at $25 a share, the difference between my target price and my purchase price. But on my cover call strategy, now I've increased my potential reward from $25 a share to $29 a share. So again, I've decreased my risk from 95 to 91, but at the same time, I've also increased my potential reward from 25 to 29. That's how my risk-adjusted return starts getting better and better as an options trader, doing the exact same trade as an equity investor. At both of these trades, they would execute the same way, but my risk-adjusted return keeps getting better and better the more cover calls and more cash secured puts that I sell. And also, because of the fact that I'm able to do this, my strategy is profitable at a much lower rate. So even if the stock declines a couple of bucks, I'm still ahead on this overall trade. And lastly, with the limit order, I maintain exposure in stock XYZ until it rises to 120, at which point my limit order is filled and I no longer own XYZ stock. However, when I sell a cover call, I can continuously generate income until the stock rises up to 120. So if it takes a year for that to happen, I can generate income over the next year on this cash that I've put aside to purchase the stock. So this is really the benefit of adding cover calls to your cash secured put strategy to help you enhance your overall yield. And this lowers your break-even price in the stock and allows you to effectively generate $4 a share more in profits than if you just simply bought and sold the stock using a limit order. So that's just a quick example of how to utilize a cash secured put and a covered call to generate or enhance your yield. So again, the benefits of this strategy is the fact that you're able to acquire shares on a dip with a discount. So not only are you able to purchase the shares at a lower price, you're also able to get a discount factor on top of it. And once you're in that stock and once you start selling covered calls, it allows you to take profit during strong rallies. And again, this statement is only true if you follow the methodology we're going to lay out here in a second. But this was really designed to allow you to capture when these stocks make these outsized moves to the upside, to be able to actually take advantage of that and take profit. And lastly, really the goal here is to allow you to generate a consistent income stream while waiting to purchase the stocks that you want to purchase and while waiting for those stocks to appreciate in value to a point where you're comfortable selling those stocks off. So those are the main benefits of using these strategies. However, there are some limitations. So important to understand what those limitations are before you start executing these strategies. So number one, this trade does require patience because generally speaking, when you sell a cash secured put and you sell a covered call, they generally only execute at expiration. They can execute prior to expiration, but for the most part, you should expect them to execute at expiration. What that means is that you can potentially miss out on some opportunities. So if that stock declines to $95 on the purchase side and goes right back above 95 just a few minutes later or within the same day, a limit order would be able to allow you to execute that trade and own that stock at $95. But on a cash secured put, if it dips below the strike price and comes right back up a few days later before expiration, you might miss out on that move. So it's important to understand that you do need to be more patient with the strategy, and it does not execute immediately if the stock goes below the strike price or exceeds the strike prices. And lastly, this strategy does require trading in at least 100 share increments. So not everyone always has the money to trade 100 share increments, especially in the larger cap names or some of the larger price stocks. But that is some of the limitations that you have. So if you have a small account, this strategy sometimes is not as suitable as those of you that have slightly larger retirement accounts or larger, trading accounts. So those are some of the benefits and limitations of the strategy. So let's now get into the strategies themselves. So as far as selecting a time frame, both cash secured puts and covered calls follow the same methodology because they're both option selling strategies. So I have a few different categories up here. I have short-term, medium-term, and long-term. Short-term reflecting mostly weekly strategy, weekly options anywhere from 3 to 7 weeks out. Monthly, medium-term options that are about a month and a half to about 3 months out, and then long-term 3 to 6 months out are the different criteria that you can choose when you're selecting expiration dates. So when you select an option to sell that's relatively short dated, what you get is a lot more certainty as to what's going to happen between now and expiration. And in exchange for that, you're going to get less income. So if you sell a 1 month call, you have much more certainty as to what's likely going to happen. So what you're going to do is you're going to receive less income. On the flip side, if you sell a longer dated option, you have a lot less certainty as to what's going to happen between now and expiration. So in exchange for that, you're going to get more income. So the question was for many people is, where do you actually want to sell, right? Because everyone wants to generate as much income as possible. So why wouldn't you just select the strategy with more income? And that is on the surface what seems to be the right strategy. But we did backtest this strategy across hundreds of stocks over the last 10 years. And what we discovered was, that fact that short dated options really were the better strategy to go with, these short dated options. And there were two primary reasons for that. Number one, when you sell short, you generally want to avoid selling going into earnings with any option selling strategy, especially cover calls and cash secured puts. You want to avoid earnings. Now, when you sell a short dated call, like a 1 month call, you can do that 12 times a year, which means that about 0.25% of a quarter of the calls that you sell or puts that you sell have this large uncertainty factor built into it, which means that you can sell cover calls 8 times out of the year, skip the 4 that do not have earnings and still be able to generate income 75% of the year. Conversely, if you sell 3-month calls, you can only do that 4 times a year. Now, every single cover call that you sell or cash secured put you sell will have that large uncertainty factor built into it. So 100% of the calls or puts that you sell will have earnings during it, and you won't really be able to avoid earnings at all. So that's not something we want to do. So for that reason, we generally find that you're better off selling shorter dated options because it allows you to have the flexibility of not selling going into earnings. The second reason, which is actually the real reason why shorter dated options are better, is because the premium that you receive, so the further out you go in time, you're going to get more income, but the further out you go in time, you don't get the same amount of payment, that meaning the premium that you receive is not linear to the time that you go. So if you sell a 1-month call, let's say you collect $1 for it. When you go out to 3 months for that same stock, you're not going to get $3 for it. You're generally only going to get about $2 for it. So what you're going to find is that by effectively taking on 3 times the amount of risk, you're not getting paid 3 times the amount of income. So that's why it's better to be on the shorter end of the spectrum, because you're going to get higher premiums for the amount of time that you're selling. So you can actually sell a 1-month call, do that 2 months in a row, skip the 3rd month when earnings is coming out, and still roughly collect the same amount of money as someone who sold 1 3-month call and is exposed through that earnings announcement. So those are the general reasons as to why when you're selling any type of options, you want to spend most of your time selling shorter dated options. Now, what that means for those of you that trade longer dated options does not necessarily mean that you have to trade weekly options. It just means that if you're selecting between 2 different expiration dates, you want to err towards the side of the shorter dated option. That will give you the better return profile of these types of strategies. So with that, let's take a look at selling cash secured puts. So now that we talked about expiration dates, let's talk a little bit about strike prices. So we have 3 different strike prices up here. I have conservative, optimal, or aggressive. And what we use is we use delta to determine those strike prices. And the reason we use delta is because delta is the only variable that allows us to control for the fact that different times of the year have different volatilities and different expectations. And we want to make sure that we have a similar approach to selling these types of strategies, or the strike prices of these strategies that are consistent year in and year out. Now, what delta tells us is the probability of that put or call expiring worthless. So a 20 delta put is something that has an 80% chance of expiring worthless. A 70 delta put is something that has, a 30 delta has a 70% chance of that put expiring worthless. And lastly, a 40 delta has a 60% chance of that put expiring worthless. And this automatically adjusts for things like upcoming news events or earning cycles. So if there's some big news that's expected to happen, volatility will be high. Delta will naturally select a strike price that's further away. When things are quiet, Delta will naturally select a strike price that's closer to the current price. So that's why we want to use Delta. Now, the lower the delta, the lower the strike. So if let's say we have a $100 stock, let's say we have a $100 stock, and let's say I have a few different choices. Let's say I have the 95, the 90, and the $80 puts to look at. So 95, 90, and let's say 85. So those are my 3 different strike prices. So obviously with each one, the stock needs to, so for the first one, it dips $5. The second one, it dips $10. Third one, it dips $15. So the lower the strike, the bigger the dip that's required for this, for the stock to execute. And in exchange for that, the larger the dip that's required, the less income that you're going to receive. The higher the strike, what you're going to find, the smaller the dip. So the 95 strike requires a smaller dip, only a $5 dip in the stock price before it gets executed. In exchange for that, you're going to get more income. So what we did is we tested all of these different strategies, and we wanted to see where do we get the best return profile for the strategy. And what's interesting to us is that we found for puts, you want to be on the more aggressive end of the spectrum. So the higher delta puts are better for selling cash secured puts. And the reason for this is because of the fact that when you're selling a cash secured put, you want a high probability of actually owning the stock, because that's the whole reason you're selling these puts, right? You're selling these puts because you think the stock's going to go higher. You're bullish on the stock. So you want to actually acquire these shares, and you want to give yourself a higher chance of owning these shares. So if you sold a 20 delta put, you only have about a 20% chance of owning that stock. That's not very high. So that's why when you're selling cash secured puts, you want to sell a high delta put. It gives you a higher probability of owning that stock. Secondary to that, the higher priced, the higher strike cash secured puts also give you higher income, which translates to a larger discount on your stock purchase. Now, who doesn't want a larger discount on their stock purchase? I certainly do. That's why I choose more aggressive puts when I'm selling for acquiring shares. Conversely, when we're looking at cover calls, this is where, again, we still use delta to select our cover calls. We use slightly different deltas. A very conservative delta would be at a 10 delta or a 90% chance of that call or put that call expiring worthless. A 20 delta, which is an 80% chance of that call expiring worthless, or a 30 delta with a 70% chance of that call expiring worthless. So the more conservative strikes, these are the higher strikes. So imagine a $100, imagine a $100 stock. $100 stock. If I'm selling a cover call that's above the current price, I can sell at 105, 110, maybe 115. So the higher the strike, the more upside I'm going to get for my stock, meaning the more the stock gets to go before the stock gets called away. In exchange for that, I'm going to get less income. Conversely, on a aggressive cover call, these are much lower strikes, like the 105 strike. This gives my stock a lot less upside because the stock only can rally 5% before it gets capped and gets sold away. In exchange for that, I'm going to get more income. So the question becomes, where do you get the best risk to reward, or where do you get the best income for your strategy? And a lot of times I see from users is they tend to gravitate towards these types of strategies because it generates more income. However, what our research shows is that the opposite is true. You're better off in the long run selling these more conservative strikes on a cover calls that have a relatively high probability of the stock of the cover call expiring worthless, and for you to keep your income. Because when you're selling a cash secured a cover call, you want to prioritize the capital appreciation of the stock. Now, what that means is that you own the stock because you think it's going to go higher. So you're taking on a huge amount of risk betting that the stock will go higher. So you want to make sure that you're paid for that risk that you're taking. And the only way you'll get paid is if the stock rallies. So in order to take advantage of that rally, you need to prioritize the giving your stock upside over income. What you're going to find is that the lower income will actually result in a larger gain in the underlying stock. Many times when you select these very aggressive cover calls, yes, you're going to get an extra 20 cents, 30 cents, maybe 50 cents in income, but many times you might be giving up $2, $3, even $5 in upside. And so what we're trying to say is that extra 30, 40 cents in income is not worth giving up that $5 or $10 in upside that you're going to get on the underlying stock, because the underlying stock is still the largest risk that you have with these types of trades. Cover calls is just meant to help you provide a small income stream. The income stream itself is not enough to offset the losses that you have in the underlying stock. So make sure you prioritize the capital appreciation of your stock over higher amounts of income from cover calls. That is a strategy that we see users use all the time, and unfortunately that doesn't work out for you in the long run. So just a quick reiteration of what we've covered here today. Number one, you want to acquire shares at a discount by selling cash secured puts. Now, once you acquire those shares, you want to make sure that you start selling cover calls immediately. You don't want to wait, because if you wait, chances are the stock might drop, and by that time it may be too late to start selling cover calls after the stock has dropped. Now, for all option selling strategies, cover calls, cash secured puts, and even more advanced strategies, you always want to use shorter dated options. So options that are less than 7 weeks out, because they maximize time decay. They maximize the speed at which you generate this income. When you're selling cash secured puts, you want to sell strike prices that are near the current price. So prioritize a high probability of owning that stock. Once you own that stock and you're ready to start selling cover calls, that's when you want to sell strike prices that are further away from the stock price, again, to prioritize that capital appreciation of the underlying stock. And lastly, you want to avoid selling cover calls going into earnings. So those are some of the tips for selling these types of strategies. And what I want to do is I want to show you two things. I want to show you the free cover call reports that we send out to everyone on Monday mornings. For those of you that are subscribers, you are probably already on the mailing list to receive this every Monday morning. It goes out at 10:30 a.m. Eastern. What we do is we scan for all optionable TSS stocks and options, and we generate two reports, an optimals cover call report and an optimized short put report based on exactly what we just taught you here today. And then what I want to do is I want to spend a little bit of time to show you Options Play, the tool, how to utilize this platform to implement what we're going to show you here today, and more importantly, show you some of those reports. So let me just load up a few different things here in the background. So first of all, for those of you that are brand new to Options Play, welcome. This tool is really designed from the ground up to make your options trading experience as easy and as intuitive as possible. If any of you have ever used an option chain like this to sell a cover call or cash secured put, you know that there are thousands many times of different expiration dates and strike prices and combinations, and many times customers get confused as to where do you actually start. Should I start on the October 4th or the September 27th or the September 20th? There's a lot of options here. How do you figure out which one to start with? And that's one of the things that we wanted to change with Options Plays. We wanted to change that user experience. So you have trade ideas and watch list here on the left-hand side. You have your security analysis panel here in the middle, and then you have trading and income here on the right-hand side. Now, today we're going to focus our attention on the income tab, because that's where we're going to use Options Play to help us find strategies for cover call and cash secured put. Now, for those of you that are first-time users, when you click on the income tab, you're going to see a button at the bottom that says Income Settings. I highly recommend you to take a look at this and create your own settings. So before, we talked about selling short, medium, or long-term options, and we learned that short-dated options give us maximized theta. And for cover calls, we have conservative, optimal, or aggressive. So we can select conservative, optimal, or aggressive for our risk tolerance. And then we can do the same thing for puts. We can use short term for puts, but again, for puts, because we want to prioritize owning that stock, we want to choose more aggressive short puts. And you can set these independently of each other. So for cover calls, I'm selecting conservative. For puts, I'm selecting aggressive. And I can save this as default. And what this allows me to do is basically type in any name. So we have a watch list that's already pre-built for you with some Canadian symbols. And this might be a list of stocks that you either own or you're thinking about owning. And when you click on any single stock, we immediately under the income panel populate two strategies. You can sell a cover call or you can sell a cash secured put. Selling this cash secured put will generate, let's start by selling the cash secured put, because that's where we want to start. So Canadian Imperial Bank is trading at 105.44. Let's take a look at selling that cash secured put. This is telling us to sell the October 4th 103 puts, which generates $115 in income. Now, that translates to 1.09% of the underlying shares. So that means that I'm able to purchase this stock at 103, which is just about right here. It was trading at 103 about 3 or 4 days ago. It allows me to purchase the stock at a lower price, plus a $115 discount for every 100 shares. So think about placing that limit order to buy the stock at 103. You'd have to place a limit order at 103, and $10,300 would come out of your account from a buying power perspective to put aside to potentially own these shares when the stock declines to 103. Now here, when you sell a cash secured put, you don't have to put up $10,300, you only have to put up $10,185. And that reflects a $115 discount that you're receiving, which translates to a 1% discount on the underlying shares. So imagine being able to get a 1% discount over the next 24 days to purchase these shares instead of placing a limit order. Those are the types of returns that you can expect when you're selling cash secured puts. Now, let's say the stock actually executes. Let's say a month later, the stock is at 102, and now you own the stock at 103 plus the 115 discount. Now, what you want to do, then that's when you want to start thinking about selling cover calls. So this is telling you to sell the October 18th 112 cover call. Thank you so much. So selling the October 18th 112 cover call, in this particular case, actually only generates $6 in income. So not much income in this particular case, only 0.55% of annualized return on a stock that already pays you a 5% dividend. And this is really where we can use the options grid. We can take a look at, well, what happens when we sell a 110 call? A 110 call generates a $24 in income, which gives us a 2% yield. So this still is only half the dividend yield that I'm getting. So in this particular case, what we typically teach is that when you're selling a cover call, you want to make sure that you at least beat the dividend yield on the stock, because if your stock gets called away, you're going to lose 5% in yield. You don't want to lose 5% of yield for just an additional 2.1% yield. So this is a stock that I may sell a cash secured put on to acquire those shares, but once I acquire those shares, there's just not enough premium on these calls to sell to generate enough income for me to lose a 5% dividend yield. So those are some of the things that you want to look out for when you're selling a cover call. But this tool is really designed to help you make this as easy as possible so that you can click on any symbol and immediately see if there's an opportunity to sell a cover call or a cash secured put. And so here, this is telling me to sell the 65.5 puts to buy the stock that's trading at 67. And then if I'm thinking about selling a cover call, notice that it's telling me that it could not find me a short-term conservative call. So it's finding me the next best alternative, which is a short-term aggressive call. So chances are this stock doesn't have a lot of listings. So it's finding me, I can also sell the October 4th 69.5 calls, which generates a 4.76% yield. As you can see, that looks a little better on a stock that pays a 4.5% yield. I'm generating an additional 4.7 on top of that, which brings my total yield to about 9%. So what I'm doing by selling cover calls on this stock is I'm increasing my yield from about 4.5% and doubling that to about 9%. Those are the types of yields that you're going to receive by selling a cover call. And this tool is designed from the ground up to really allow you to type in any symbol and immediately see where is your starting point that you should be using for selling cover calls and cash secured puts, instead of forcing you to use a page that looks like this, that sometimes is confusing as to where to start. And even if you know where to start, you still have to manually calculate, okay, how much does 42 cents in income generate in terms of yield? And am I going to get enough yield from that to beat the dividend? There's a lot of manual work involved in that, versus here, you just type in a symbol, we'll tell you which cover call to sell or which cash secured put to start with. And you can use the income settings to create your own settings, save this as default, and then allows you to click on any symbol and immediately see which cover call, which cash secured put makes sense. Now, with the few minutes that I do have left, I do want to show you this report that we generate every single morning. This was generated on Monday morning, which basically shows you which stocks and what yields you can expect from those specific stocks. So this tells you the stock, the strike price, the expiration date, as well as the annualized return. This gives you a sense for how much yield you can find, on all TSS stocks. You can use this to scan for opportunities to buy stocks, and we even have a short put report for those of you that like to sell puts to show you where do you have the highest yield when you're selling puts. Notice some of these have very high annualized returns. So on a lot of these stocks, especially for those of you that like to sell some of the, buy some of the cannabis stocks, buying some of these cannabis stocks, you can get 5-6% discounts on the stocks by selling a cash secured put instead of placing that limit order. So imagine being able to get a 5% discount on some of these marijuana stocks. I know they're very volatile and 5% doesn't sound like a lot, but it does do a lot to boost your bottom line if you're able to get a 5% discount on your cost basis for all of these holdings. And that's really how you can utilize options to create a better risk-adjusted return for your strategies. So with that, I'll just take 2 minutes and roll back to real quick to cover some exit strategies. So number one, with cash secured puts, there aren't really any exit strategies, because when you sell a cash secured put, there are two possible outcomes. You either own the stock or you keep the income. And those are the two outcomes. There's really not much that you need to do elsewhere. When you sell a cover call, there are a few different scenarios and different ways to handle them. So when you sell a cover call, you can have three things that can happen. The stock can move significantly higher, it can move sideways, or it can move significantly lower. So normally what we see is that when the stock rallies significantly, this is where most people tend to panic. So when the stock rallies above your strike price, we tend to see people will panic a little and say, I don't know what to do. So what we're trying to say is when the stock rallies significantly, you want to hold on to that cover call. You don't want to do anything early. What you want to do is you want to wait till the last week. And if you need to roll that cover call, wait till the last week to do that. Because if you do something too early, the stock can always come back down below the strike price before expiration, and you would have been okay. But if you do anything early, you've locked in a loss. You don't want to lock in that loss. Second of all, if you do something early, you're really not taking advantage of that time decay. You want to make sure you wait until that last week, capture all the time decay, then decide that if you don't want to lose a stock, to roll that cover call to a new expiration date. In the second scenario, if the stock goes sideways, this is really your best case scenario. You want to hold on to that cover call, you want to let it expire worthless, and you simply want to rinse and repeat and do that over and over again. And lastly, in the scenario where the stock drops significantly after you sell the cover call, this is the only time where it makes sense to do something early, because you can capture the profits from the cover call, pretty much all of it up front without waiting till expiration. And the rule of thumb here is if you can buy back a cover call that you've sold at 20% of the premium that you sold it for, that's a good time to buy it back. So for example, if you sell a cover call for $1 and now you can buy it back for 20 cents or less, and there's still 2 weeks left to go, you want to buy that back, capture those 80 cents, lock in those 80-cent profit, and sell another cover call even though you still had 2 weeks left to go. So that's really the three different scenarios that you'll find yourself in when you're selling a cover call, and generally how to handle that. So with that, I hope that what we were able to do is really show you, what options play is really designed to do. It's really designed to replace manually searching through pages like this to figure out where to start, by just pointing you to exactly the expiration, the strike price, and more importantly, giving you the metrics to decide whether a cover call is worth it for you or not. So this cover call generates a 3% yield on a stock that pays a 4% dividend. A lot of these financial stocks were not finding much yield. So maybe this cover call is not worth your while. But if you're thinking about buying the stock, you can acquire these shares for about a 60 basis point discount. That's not insignificant. That's instead of placing, $10,050 to purchase the stock at 105, you only have to put up $99.87 because you have a $63 discount, which generates about a 9% yield on that cash that you're putting aside to purchase these shares. So many times I find that cover calls is a strategy that many people are familiar with and utilize, but the cash secured put is a very underutilized strategy. So I hope that this webinar was able to help illuminate the power of cash secured puts. Puts trade at a higher premium than calls, which means that you can generate more yield, which generates a larger discount factor. So it's definitely something that you should consider in your toolbox as an equity investor. The next time you're thinking about buying a stock with a limit order, think about selling a cash secured put. Look at how much discount you can receive on that stock by putting a cash secured put instead of a limit order, and chances you'll find yourself quite surprised as to the type of yields that you can receive by selling a cash secured put or a cover call. And lastly, please check out the reports because they give you a good sense for how much discount you can actually receive. Even in some of the larger cap names, you can still see plenty of names giving you greater than 1% discount on selling on big names like Manulife. That you guys probably currently own in your portfolio. SU, MFI, TRP, CNR. These are all big cap names. Look at the types of yields that you can get, the discount factors that you can get. So the next time you're thinking about buying any of these stocks, take a look at our short put report. Give yourself a sense for how much of a discount can I get by selling a cash secured put instead of placing that limit order. And hopefully this will help give you a sense for the type of yields that you can get. So with that, I want to thank everyone for taking the time out here this afternoon. I hope that you guys have found this useful in, number one, understanding the strategies, but more importantly, understanding how to utilize our platform to implement these strategies. So please, at this point, if you have any questions regarding anything that I just discussed here today, please type them into the chat window and I will try to answer as many questions as I have time for here today. So I know there's a few questions already. I'll try to address them. But please, if you have any questions, please type them into the chat window. So Alex is asking, please clarify rinse and repeat. So rinse and repeat simply means that, let's say I sell this cash secured put on Royal Bank of Canada, right? I sell the 100.5 puts, and let's say a month later, the stock stays at 102. So I've kept my $63, but I still don't own Royal Bank of Canada. But I still want to own Royal Bank of Canada. I still want to purchase it at 105. It just hasn't moved lower. So I can sell another put. And that's what I mean by rinse and repeat. So if the stock doesn't go to that strike price and I don't own the stock, I can sell another put and generate another $60. And I can keep doing that over and over again until I actually own the stock. So that's what I mean by rinse and repeat. Azim, Tony, can you explain later on that Excel list? I get the list, but are those all optimal? Do you have any research after the fact how many have expired worthless? I find that some have minimal income, say $25, and after commissions, there's not much left. So yes, these are all based on our optimal strategies. So that's why we created this report, right? It's not, at the end of the day, I can't control what the premiums that different options trade at. I can only show you a report to tell you that. So the ones that have low premiums, you should probably not sell them because you can't even cover the commissions on them. But this report gives you an idea as far as where there are opportunities. So that's really what the report is. The report are all of the optimal ones. You can certainly filter them out by bid price. You can say only show me ones that are greater than a certain amount. That's really why we created this report, so that you can do your own filtering and only look for stocks that are worth your while. Giovanni saying, where do we see the deltas on your platform from your trade suggestions? Also, we place a cash secured put in order to buy them at a discount. Any other benefit? I wouldn't say there are any more benefits of selling cash secured put. The primary benefit is to purchase these shares at a discount. As far as seeing the deltas, you can always click on the blue button on any strategy. So let's say I'm trying to sell this. Let's go back to the cash secured put. Let's say I'm trying to sell this 100.5 put. Click on the blue button, and there's a button here at the bottom that says Explain Strategy in Greeks. This will tell you the delta here. So that's how you can find delta. Will there be a replay of today's webinar? With all of our webinars, they are always recorded and you will always get a replay after we finish here today. Someone's asking about cash secured puts allowed in a registered account. If I'm not mistaken, I don't believe they are, but I'll open that up to the group if anyone can comment in Canada. I unfortunately do not live in Canada, so I'm not subject to those same regulations. But if anyone can comment on that, that would be very helpful. Can you explain the 9.36% annualized return on selling RY puts? Yeah, absolutely. So if you can collect $63 over 24 days, and you can expand that out to the whole year, that would come out to be 9% of the underlying stock. So if you basically take 365 divided by 24, the number of times you can do that for $63 each, that's how 9% is calculated. It's just an annualized number of the 62 basis points. Sandro's asking, are previous webinars all available to watch again? Yes, all previously recorded webinars are available to watch. There's even an options video library. Let's see. So you can see all of our previously recorded webinars here at this link. You see how there's an options play section here. So we have a lot of different videos that you can watch. They're all here available to you on this link that I just sent to everyone in the chat window. Daniel, is the cash secured put strategy only useful if you're bullish on the underlying stock? It's a stock acquisition strategy, so you generally don't want to acquire a stock unless you're bullish on it. So I would say yes. Al is asking, thanks, Tony. Really appreciate your webinars. Things are coming together. See many opportunities. Great. I really appreciate that. Azim, can you put deltas in the spreadsheet? So all of the ones in the spreadsheets are all within the same delta. So as you can see on the optimal puts, they're all 30 deltas. On the cover calls, they're all 20 deltas. So that's why we don't put deltas, because they're all the same deltas. You mentioned keeping the cover call till the last week of the stock price increase, but if you hit the strike price before the last, week, since these are American options, they can be exercised at any time thereafter. Can you comment? So American options does not, just because they can be exercised, doesn't mean that they make sense to be exercised, because if you exercise early, you're effectively leaving money on the table and throwing money away. Because if let's say I'm selling this cover call, right? Let's say I sold the, I don't know, the 100s, right? The 100s, and it's currently trading at 335. Now, this call is only $2.32 in the money, but it's trading at 335. So would you rather capture $2.32 in profit, or would you rather capture $3.35 in profit? I would tell you that no sane person would ever take $2.32 over $3.35. So that's why it always makes sense to sell the cover call at a profit rather than exercise early, because I'm basically giving up $1 in profits. So that's why American options, even though you can exercise early, from an economics perspective, it never makes sense to actually do it. Thank you, Tony. Always great to attend these seminars. I hope that we can connect on a one-on-one basis this week sometime. So for those of you that are attending the Options Education Day in Toronto, I will be there this weekend. So for those of you that are in Toronto, I do recommend that you sign up if you haven't already. Patrick, are U.S. securities included in options play? So not in the free version with the TMX, but if you want to sign up for a free trial, you can sign up at optionsplay.com. That gives you a 30-day trial to options play with US listed securities. Giovanni, no, the Canadian version does not offer that. That is only offered on the US version. Raymond, thank you so much. Francois, only cover calls inside registered accounts. Okay, so that I think answers a question earlier about that Stefan asked about cash secured puts allowed in a registered account. So the answer is no, you cannot sell a cash secured put in a registered account. Giovanni, thank you. Patrick, thank you so much. I really appreciate it. John is asking, does the tool account for fees? No, it does not account for fees. Joseph, Serge, thank you so much. I really appreciate it. Patrick, Shama, and Stefan, thank you so much. So again, I hope everyone has found this useful. I really hope that this was enlightening for you guys to understand how options can be used to enhance your equity positions, and that's really how you should be thinking about this. It's a tool for your equity positions, not just for speculating. So Thank you so much for taking the time out here this afternoon. I will see those of you that are in Toronto this weekend, and I hope to see you guys back here in a few weeks on our next webinar. So I hope you guys have a great afternoon and a great end to your week. Have a good evening.